Good morning, everyone. Martina here with Real Broker in Fayetteville, North Carolina. I have been assisting clients to buy, sell, and invest in real estate in the Fayetteville market for a little bit over 10 years now. And I'm here today with my preferred lender, Kevin Rodriguez. Take it away, Kevin.
Thank you. Hey, Kevin Rodriguez, Encompass Lending. I'm a regional vice president. This is my 30th year giving money away. We're here in Fayetteville, North Carolina, next to Fort Bragg. So you can imagine we've done a ton of VA loans. And today we're going to talk about loan estimates and how to really compare a loan estimate. They're confusing, I think, to somebody who's looking at one trying to compare two lenders to determine which one is actually better for them. And so there's some issues with this form, and we're going to talk about them, and so that you can, whether you're a real estate agent or a client looking at two loan estimates, what do you look for, and how do you know which one's better? Because if you just look at the interest rate and the bottom line number, you're going to be misled more times than not. So we're going to jump in and talk about it.
Well, I already have a question right off the bat. How
Okay.
many people actually get loan estimates from different lenders? The way I understand it, you get a loan estimate before you go under contract to see, what the numbers are really going to be like. And at that moment, you really have committed to a lender. So where would you get different ones?
Right. So this is kind of interesting. So when we have a complete application, and a complete application includes a property address, we are required by law to provide you a loan estimate within 3 days. Now, I do get a lot of times that's not until you go under contract because you don't know what house you want, right?
Right.
So we've talked numbers. We maybe sometimes look at what we call a worksheet. It's not technically this form. This form was built because now it's uniform amongst companies so everybody can look at the same form and compare numbers. And it should have made the process easier to compare. But there's a few little things that happen on these loan estimates that are misleading, or maybe it's not misleading. Maybe that's the wrong term. But what the big problem is as a lender, there's only a few items we control, but we have to estimate all the fees that you're going to have, and we don't control them.
Mhm.
But if we miss one that we knew you were going to have, then we have to pay for it.
Oh
So
boy.
you can imagine that we're going to put it on there. Now, then you could have a change of circumstance. There could be something that happens like a final inspection for an appraisal, right? I don't know you need a final until the appraisal comes in and says, hey, there are repairs. So
Right.
now once I know you're going to have this fee that I didn't show you up front, I have 3 days to disclose to you that, hey, you have this new fee. And so you can do a change of circumstance. You can change things as they come up. But obviously, we don't want to eat any fees, right? So we
Right.
try to be very careful in showing you what you're going to have and keeping it in a reasonable amount. Now, the thing that gets really hard, the larger the company gets, right? We're doing loans in 46 states. So we're going to estimate a pest inspection based on the average across the country because our system's going to put it in there. And it turns out here in Fayetteville, it's about half of what we show on the estimate, right?
Hmm.
So, I mean, there's different things like that that make it difficult as well. But this form has freed up a lot of people. So the question was, how many people actually look at it? I would say about a lot of customers will price shop, but they go online and they look at numbers and you got to then go into the fine print to see, hey, when they're advertising that interest rate, does it show you what the credit score was? Does it show you what the loan amount? Does it show you how much money they put down? Does it show you the discount? You know, how much they were paying to buy that rate down? And so a lot of times, if they're comfortable with that, they don't really go further. But it doesn't hurt them to get two estimates. It doesn't hurt for multiple mortgage companies to, look at your credit report and give you a real application and give you real numbers. And so I would say 25% of the clients actually go that deep and look at multiple estimates.
That sounds good. And I think it would be super helpful for realtors also, to have a good understanding what actually is on the loan estimate so they can intelligently discuss it with
I
their clients.
promise you, if you're a real estate agent, you're gonna learn something today.
Yeah.
This is here. All right,
Yeah.
well let's jump in. So this is a VA loan that we set up, and this is a $350,000 purchase price.
Mhm.
Well, the first thing you notice is the loan amount. VA has no down payment; they finance 100%, and the first thing you see is the loan amount is higher than the purchase price.
Right.
Well, that difference is the VA funding fee, right? The VA lets you finance in the funding fee. So we did a um, first time eligibility 2.125 funding fee. Interest rate here, principal and interest, payment. But here's your total payment, because here's where we estimated taxes and insurance and gave you a total payment. I actually looked up a property that we used that was here in Fayetteville in the city limits, probably the highest of the tax rates in the area. And we came up with this figure here. Now, I'll tell you a great example of this is not, I don't want you to think that today's the 6th January and I've got a 1% discount in this. I actually locked one yesterday at 5.5.
Oh,
So
wow.
this is not, this is just for example purposes, right?
Right.
Now, if you scroll down here and you see this number right here, man, you're going to panic. I've got almost $21,000 in closing costs. Well, in this scenario, I'm showing you a lot of stuff. So you've got about 13.4. The difference there is the VA funding fee. This is cash to close number, because we're not showing that you paid any due diligence, you paid any earnest money, any deposits. We're trying to show numbers. So let's get down
let me
into,
back this up for a second. Out of the 13,387, if you paid 1,000 in due diligence and 1,000 in earnest money, that would be a credit off that number, right?
Correct.
Okay.
So any deposit you do on the contract gets credited towards the amount of money you need at closing.
Okay.
And so if you didn't need any money at closing, let's say the seller in this case was paying all the closing costs, you'd actually get that money back.
Cool.
Okay, right here. This is section A. This is the section that we control as a lender. So you're normally going to see some kind of commitment fee, origination fee, some fee that's going to the lender, right? This is the money that's coming to us. These discount points here, I put in 1%. Most advertised rates you see, you'll have about 1% discount. I'll see a lot of like 1 to 1.25 on different websites from major national lenders that people might look at. Now, keep in mind, this number is optional, right? You are making the decision that, hey, I want a lower rate, and you really need to do the math to make sure that, hey, if I'm going to spend $3,500, how long is it going to take me to get my $3,500 back?
Right.
More times than not, 1% in discount is too much to pay. You might be able to pay 0.25%, 0.3%, get a rate, say around 6%, and you didn't spend as much money, but instead of having a 6.25, 6.5 rate, discount points are not 1 for 1. A lot of people think if I pay 1%, my rate's 1% lower. Not how it works. Okay.
However, let's talk about that a little bit longer. For example, if we have active military that's PCSing into Fort Bragg, and let's say they sold their house in Colorado and have made a lot of money, and they would like to take some of that money. Would you suggest they spend it on points or make a down payment? What would be the best way to go?
Great. All right. So let's talk about it. So when I'm looking at locking interest rate, if you can make your money back in 24 months or less, that's a green light go. If it's going to be 3 to 5 years, then it really depends on me. How long are you going to own this property?
Right.
Yeah. Right now, there's a good opportunity that I think we're going to see. If you look at just data and what everybody thinks, right? We think rates are going to be slightly lower in 26 by the end of 26. So if there's an opportunity to refinance technically for free, do we want to spend a bunch of money? But if we can get that rate for the right amount, then it makes sense, because now I'm not going to spend money refinancing. But are you going to be in the property a long time? How fast can you get your money back? And how much money do you have? So if we're in this scenario, if I was looking at a client who had, let's say $15,000, $20,000 in the bank, I don't know that I want to spend $3,500. That's a large chunk of your savings, right?
Right.
If you sold a house and you got $100,000, and we were going to do this payback, and let's say the payback was going to be 4 years. Okay, I can get by with that. I think if you got a rate of 5.5, I doubt you're refinancing that in the future. I don't think we're going to see rates below 5%. And so that would kind of be the threshold where I'd look at trying to refinance. And I don't think you're going to get there. So it really depends on the client.
Okay.
I mean, it
Sounds
really
good.
depends on the client. So keep in mind, there's a lot of fees on here. This is the box we control. This is it. Okay. So if you were going to compare two lenders, you can't compare this cash to close number. You gotta compare this number, because I would argue that this cash to close number, if you would have closed the same house with me and the same house with somebody else, these fees, the attorney fee is going to be the attorney fee. The title insurance is going to be the title insurance. The appraiser is going to be the appraiser. Your taxes are the same. Your insurance is the same. 95% of this other stuff is going to be the same. So no matter what number we showed you up here in the estimated cash to close, it was going to be the same in the end. The question is who's giving you a better number. Now, I'll admit I would rather estimate a little to the high side, because clients don't get mad when they're bringing, less money. We're supposed to try to be as accurate as possible, and I want to give you a real number. Normally, I give you this number estimate, and then I tell you, here's what I think your real number is and why. And we kind of talk about it. All right, so appraisal. In our market, the VA appraisal is $800. You're gonna have a credit report. Everybody's gonna put this number at a different number. A doc fee, you may have it, you may not have it. We do e-closings. It's a hybrid closing where all the junk docs, you get to e-sign them, and the important stuff you sign with the attorney. Employee verification. You only have it if your employer charges for a verification fee. If you're active duty military, we get your verification employment from a website. It's a fee you don't have, but it's a fee you could have. Therefore, it's on there. Flood cert, everybody's going to do a flood cert. Make sure that the house is not in the flood zone. We monitor your credit report, undisclosed monitoring debt fee. Make sure nothing changes. You don't want something to pop up on your credit report, and then 24 hours prior to closing, when we refresh the credit, we find out there's an issue and we're postponing your closing. This monitors it the entire way. And here's the VA funding fee, right? That's going to be the same no matter what lender you pick. Your fee depends on first time use, second time use, disability, putting money down, etc.
And that goes directly to the VA, right?
It goes to the VA. It's financed in. That's what we talked about in the beginning. So now let's get into this one right here. We call it services you can shop for. Mm-hmm. So what's interesting in North Carolina, we're an attorney state. We close on an attorney. Typically speaking, by the time I have an application, you've already picked the attorney, right? And usually the real estate agent is helping you with this, because unless you have an attorney that you've used, or you're new to the market, you're going to want to use a real estate attorney that does real estate closings full time, and that's the majority of their business. Yeah. So most of the time, as a real estate agent, we say, hey, this is where we're closing. A lot of times the seller's dictating where we're closing. And then there are times where we have two different attorneys, a seller attorney and a buyer attorney. But in a VA loan, you have to have a pest inspection. But these title items are what I call attorney fees, okay? So what I will tell you is, and then look here where it says title examination fee, $900. That is basically the attorney fee. You cannot charge an attorney fee on a VA loan. So they have a title examination fee. A lot of times on a conventional loan, they'll have an attorney fee and a title exam, but the title exam will be a cheaper amount. Mm-hmm. However, I would say that attorney fees, when you either have a big fee or a bunch of little fees, and they're right around $1,100, $1,200 plus the title insurance. Title insurance is a percentage of your loan amount, and there's usually a lender's policy, and up here somewhere there is a buyer's policy, owner's policy right here in H. That it's very inexpensive, so we almost do it automatic. Title insurance, super important, required by law. In my 30 years, I've only seen it needed 2 or 3 times, but man, when it's needed, it is needed.
I have seen it needed. Yes,
it is definitely a great requirement. Yes, a small amount to pay for what it does. recording, we talked about this in another video. When you close a loan, the house isn't yours until the attorney records it at the courthouse. This is based on, number of pages. We get into homeowners insurance. So here's one where a loan officer, two loan officers can have estimates that look different. I have to estimate normally your homeowners insurance. I don't know what your homeowner insurance is going to be. I don't know how many claims you've had. But what we do when we're estimating it up front, we're looking at, just from experience, similar homes, similar loan amounts, similar credit. Because we do so many loans, I can go in and go, well, hey, I just did one in that neighborhood last month and the insurance was this. Let's use that estimate, right? So usually the estimate's pretty good. If we have a deal that's super tight, we're going to get an insurance quote up front. But normally at this point in the process, you haven't picked your insurance yet. And so we got to plug a number in. So if someone picked a very low estimate, it's going to make their payment look better. It's going to make their cash to close look better. We want to try to get the number right. Another big one that will make an estimate look off, especially in larger loan amounts, is daily interest. So if we close on the 15th of January, you're not going to have a February payment. Your first payment is going to be March 1st. Well, if we put this for a closing at the end of the month, you don't have any interest and this $600 goes away. If we put this on the 5th, let's say the 10th of the month, well, this is 20 days and now this is $1,200.
Yeah.
Typically estimates will trigger about if you don't put in a closing date, it'll trigger 15 days. So that's kind of in the middle.
Right.
If someone was trying to make their number look better, they would tag this for the end of the month. Well, at this point, when I get the estimate, I know the closing date, and so I'm putting in a closing date. So I just pick something that was roughly a little more than 30 days from the day, or right around 30 days from the day. I pick something in the middle of the month. I always like to close Tuesday to Thursday. Fridays are always a nightmare. End of the month's always a nightmare. Mondays are they're fixing the problems from Friday.
Yeah.
I love Tuesday, Wednesday, Thursday. Great days to close.
Haven't we all learned that the hard way? That's
yes. Yeah. I don't want you in a hotel or moving truck over the weekend.
That's right.
Things are recorded, right? This one right here, the escrow account. This is one where numbers can vary drastically, and a lot of times you'll see 2 and 2. If you see 2 months and 2 months, they did not do the calculation. Okay.
Wow, that's good to know.
Yeah, because it just will default to it. Most programs will default to it. Taxes normally net out to 5 months. And when I say net out, right, this is different because we're in the beginning of the year.
Right.
But if we were closing in, let's say, the end of June, say we're closing June 30th.
Yeah.
Well, the client is going to have to pay the bill in November.
Right.
And if we were closing the end of June, they wouldn't have a July payment. Their first payment would be in August.
Right.
There's got to be enough money in that escrow account before you get to November to pay the taxes. So you got to load this up with the escrow account.
Right.
But they get, and you don't see it on here, there's a proration of taxes. The seller is going to give them a credit for the first 6 months,
right.
But you don't see a spot on here for that. So if you see, I'll say 4, 5, or 6, that's a good net number any time of the year. If you see it like it's got 10 months in it or 12 months in it, well, it might make your cash to close number look too high if you don't factor in the fact there's going to be a proration of taxes.
Right.
Okay. That one to get a lot of people. I would say the things that make an estimate look higher more times than not are that this escrow account and the daily interest. These are where you can really, you could lowball the taxes, you could lowball the insurance, you could lowball the escrow amounts, the number of months, put the close in at the end of the month, and you can make these numbers look really low, and it can be shocking to the client when you get there and these numbers are really different, right?
Right.
One thing I've seen, a little trick I've seen is, usually we talk about points or discount. We'll say, all right, this is the rate, and this is the fee for the rate. I've seen a lender go, well, we only charged 0.25% in discount. Well, yeah, because they charged 1% in other fees, right? They just put it into something else.
Yeah.
So total lender fee and what's your rate. That's if you're trying to compare lenders, that's what you're looking at, right?
Okay.
All this other stuff. Now, I'll admit there might be somebody who doesn't pass on a fee here. Their credit report's a little more, a little less. We cannot make any money on third-party fees. So if you don't have that fee, you don't pay that fee. If the fee is less, like for instance, the pest inspection, a lot of times they're done with the home inspection. Sometimes they're 70, 80, $100. You only pay what it is. So regardless of what we estimated at, you pay the third party what it is.
I think
Now,
it's super important to understand for buyers all these moving parts that you just explained. Things that at
right,
this point, because let's not forget, this is done before you even write a contract, before your contract is accepted, right? Because this
right.
is the basis for you to know, can you afford that house or not, right? Can
I
you
think
afford
it's
the monthly payments? So it's super important for buyers to understand that the homeowner's insurance premium, all of that are moving parts that you don't know 100%.
a great example. I have a client right now looking to build a house on a lot they own, and they had a number in their mind that they price range they wanted to stay in,
Hmm.
but they really didn't have any idea what that meant in payments.
Right,
And so, what are the taxes? What are the insurance? What is that going to look like? And so knowing, hey, what's a comfortable payment? Whether you qualify or not, what is comfortable for you is very important because you might, qualify for a $4,000 payment, but
yeah,
that doesn't fit your budget. And how much can I afford to spend out of pocket? And we never want to use all your money, right? That's
right,
never a good
right,
idea. So making sure we have the funds. And let's say we get a situation like this right here where client, the money might be tight. We could take this 13.4 number. I'm going to round it up 13.4. We could get rid of this origination. I
hmm,
mean, this discount point, right? That could get us down to 10,000. We might ask the seller, to pay some cost, right?
right,
Maybe 5,000. I'm making up a number. So now we're down to 5,000 out of pocket. And there's also ways for us to do, a lender credit, or maybe we shop the insurance a little better. Maybe there's things we can do that can get this number down. But even this number here, if this was closing next month, well, there's at least 1 month of taxes
hmm,
that's going to be prorated, right? So that's
right,
$300. This is going to be, $75, not
right,
150.
yeah,
We're not going to have a verification employment fee because you're military, assuming you're active duty military. So, I mean, there's even things on here that are already going to, drag this number down. We could easily get this number into, I'm going to say $9,000. Um, and now you're, you know, get the seller to pay some of it. Now you're very low out of pocket.
yes. And I mean, the way the market is right now in Fayetteville, we see sellers making concessions, you know?
Starting to see more of it. I'm
Yes,
starting to
we
see
see
more of it
much
almost
more
in
of it.
every deal.
Right.
Yeah, and then there's another question of that comes up a lot. Like, should I? Let's say the seller's going to pay $5,000 in closing costs. Well, is it better to get a price that's $5,000 less, or is it better for the seller to pay $5,000 in closing costs? Well, if you pay $5,000 less for the house, you're going to save roughly $30,
Right.
about $6 per thousand. Rough, very rough figure, right? So you can save $30, or you can have $5,000 less out of pocket. That depends on the client. If the client has a lot of money, then we want the house as cheap as we can. If the client does not have a lot of cash, then we want to spend as least out of pocket as we can. So if you're again, if you've got $20,000 to play with, and your closing costs are going to say between $8,000 and $10,000, and we can get $5,000 from the seller, I mean, that's
Right.
25% of the money you have. I mean, that's a no doubt. We take the concession.
That sounds good.
Yeah. But I think when you look at these, don't jump to this bottom line number, because there's things even on my estimate that you might not have.
Right.
And there's no proration of taxes listed on here, so this number is going to be lower. And keep in mind, these are the only numbers that we can control. And when it comes to discount points, we're going to do the math for you to see if it makes sense.
And again, it boils down to having a good realtor that negotiates on your behalf. to make sure you get seller concessions, make sure that the services you shop for, you're being, advised to good providers, that do a great pest inspection for a reasonable amount of money. Those are also things that are super important. And then especially when you're on a VA loan, for the inspections, there's not only the pest inspection. If you have a house that's on a well, you need a water inspection.
Oh yeah,
Water
there's things that
inspection.
could be on here, right? There's
Be on a
water
septic.
test,
Yeah,
well,
you need a
septic.
septic inspection. There's a whole slew of other things that might be required, and that all will go into box C.
Right.
So I think this was super informative. And I'm with you. I think most people just jump down to the last box, estimated cash to close, and make the decision on that. And it's super, super important for potential buyers to understand the whole estimate and understand what's fixed, what's not, what can change, which numbers don't you know at this point.
Right, right. And I'll tell you, it's hard to do a true estimate if you don't have a full application.
Yeah.
Because we really need to be looking at all the variables. Now, one thing that comes up a lot is like, well, how much do I qualify for? And we're doing an estimate on 350. And so the problem is going to be, we can take 3 homes at 350 and have totally different payments because the taxes and insurance for those 3 homes are going to be different based on location and age of the home. So, a lot of times when we're just kind of ballparking, we're ballparking, but then when we actually get a property, we can get really tight on the number and get really close. I'll tell you, when we're talking to a client, if they're paying more than $100, if I miss the total cash to close by more than $100, I'm usually not happy. So, I mean, we're going to do our best to get it, down to what we can. And especially if you're closing in North Carolina, right? I mean, I've been doing this 30 years. I often know what your numbers are going to look like.
Right. So. Well, let me ask you this. So if this is the loan estimate, how close should it really be within $100 compared to the preliminary CD that you disclosed 3 days before closing? How close should it be?
Let's go through that. So this is going to continue to get better along the way because, again, usually up front, I'm guessing your insurance, right? So we're going to plug your insurance number in when we get it. If it's significantly higher, we're going to talk about, hey, do we want to get another estimate, or is there a reason it's higher? Make sure you understand the number change. Do you need a final inspection? We're going to talk about it. So I would say early on, about 2 weeks in, this number gets really tight. So then there is the initial or pre-CD. So you get to see the same form, but instead of being called a loan estimate up here, it's called a closing disclosure. You have to see that at least 3 days prior to closing. And there are fees on there that can't change at closing. So there's going to be things that still come off because you didn't have them. And then we're going to balance the CD and we're going to get a final number. And you usually actually get the exact cash to close number, I'll say 24 to 48 hours in advance. But you're going to have this number for the CD. We like to get it out as soon as we can. And a lot of times we'll send it out a week ahead of time, but you have to have it at least 3 days prior to closing.
Yeah. Well, let me ask you this. Should the buyer assume when you disclose 3 days before that they have to clear to close? Is it sort of the same thing, or is there a difference between the clear to close and getting the preliminary CD?
Everybody does it differently. We want to disclose that CD as early as possible. And start a semi-balance with the attorney a week ahead of time. That way it's just faster so that when we have the clear to close, we can execute. Some lenders will not send out a closing disclosure until they have a clear to close. And then the problem is if that's late in the process, they send the CD out and that pushes you out, 3 days. The CD can be sent out prior to being clear to close.
Cool. Well, that was definitely some fantastic information, and it will help a lot of buyers to understand, where the bottom line, the estimated cash to close actually comes from and what goes into it.
And if you got questions about one, whether it's mine or somebody, else's, call me. We'll walk you through it, tell you what to look at, tell you what's right, tell you what, especially, I talk about this all the time, you want to use somebody local because they know everybody, they can get the deal right, they know everything that's going on. You're going to be able to estimate things better. If you're in, Philadelphia, I mean, I don't know what your attorney fee is going to be, but if you're in Fayetteville, North Carolina, I promise you, I got the attorney's phone in my cell phone. So,
and what's also important for buyers to understand, and I get that a lot, people that are PCSing and they want to, have their lender be one of the big, huge nationwide companies. And they don't understand. You have an 800 number. And when you need somebody, they're sitting in California, they're sitting God knows where, you can't reach them. And there's companies out there where, I mean, as a realtor, you need to follow up. As a buyer, you need to have contact with your lender. And if it is super hard to get a hold of somebody, that's a big problem. If I refer my clients to a local lender here in Fayetteville, if there's a problem, they don't pick up the phone. Guess what? I'm getting in my car. I'm rolling up on their office and I'm getting answers. You know what I mean? And
Right,
that's
right.
important. And I do it.
Hey, the best ability is availability, right? So
That's right. That's
being
right.
able to help the client, I tell people all the time, like, man, I'm going to see you at Harris Teeter, right? I'm going to see
Right.
you at the ball field somewhere.
Right.
You are going to look over and say that guy took care of me. I don't have a choice, right? This is where I live. I
Exactly.
can't hide in a cubicle in Texas somewhere and not talk to somebody.
Yeah.
So a lot of things go in this. We say this all the time. If this was easy, they wouldn't need us. And this is not easy. There's a lot of moving parts, and we try to take care of them.
Yes. Well, Kevin, this was great. Thank you so much. And as Kevin said, if you guys have any problems about a loan estimate that you've received, even if it's not Kevin's, feel free to reach out. And I'm going to have his contact information in the description of the video. Have a great day.
Great. Thanks.